Options don't just reward strategy, they punish mistakes. Let's talk about 4 ways to stack the odds in your favor. In this video, we'll show you 4 strategies to manage risk and protect the value of your portfolio using options. Options can be a powerful way to gain exposure to stocks or express a view on the market. And they can also be used strategically to manage risk in your broader portfolio. But like any investment, options carry risk too. Their prices can move quickly, and that can lead to significant losses if a trade goes against you. That's why learning how to manage options risk is such an important part of becoming a successful options trader. One of the simplest and most effective ways to manage risk is position sizing, deciding in advance how much of your portfolio to allocate to a single trade. Keeping your position size small, especially when you're starting out, can help limit the impact of any one trade on your overall portfolio. You can also develop an exit strategy by thinking about what you'll do if the trade moves favorably, unfavorably, or stalls. This can include a mental stop-loss level where you set a price point to exit the trade if it moves too far against you, then follow through on it. This takes discipline, but it can help prevent a small loss from becoming a bigger one. Just like with stocks, diversification can help reduce risk in an options portfolio. You can vary your trades by expiration dates, strike prices, different underlying stocks, and even by combining long and short positions, meaning some trades benefit if the stock moves up and others if it goes down. The goal is to avoid putting all your risk into one trade or relying on a single market outcome. A balanced approach can help limit the impact of a single losing position on your portfolio. Diversifying your options is like packing a suitcase. Instead of bringing one outfit, you pack for different possibilities, so you're ready for anything. Sometimes a trade just needs more time to work out. If the market isn't moving as expected, you might roll over your option, closing your current position and opening a new one with a later expiration date. This can give the trade more time to play out, but it's important to be aware of the trade-offs. Even if the stock hasn't moved, buyers of the option will likely lose some value due to time decay. Option sellers may benefit from that decay, but rolling either position will involve transaction costs. So far, we've been looking at how to manage the risks that come with trading options. Now let's shift focus to how options themselves can be used as tools to help manage risk in the rest of your portfolio. For example, if you own a stock and you're concerned about a short-term drop in price, you can buy a protective put option. If the stock falls, the value of that put may rise, helping to offset some of the loss. However, this protection does come with a cost and is only valid for the time period that you choose. Once your put expires, you'll need to purchase a new put to extend your protection. You can also buy puts on broad market indices, which can provide a layer of protection during times of heightened market uncertainty. Another approach is to sell call options on stocks you already own, a strategy known as a covered call. This can help generate income and cushion some downside risk, especially in flat or slightly declining markets. It's a way to manage risk without having to sell your investments outright. Note, however, that your stock could be assigned or sold if its price rises above the strike price at or before expiry. Now that we've shared 4 ways to manage risk, here are some final thoughts about dealing with uncertainty as an investor. These strategies can be especially useful in uncertain markets where volatility can lead to sudden or unexpected moves. If you're unsure about the market's direction, managing risk becomes even more important. Long-term investors can also benefit because options offer ways to protect your portfolio during periods of turbulence without abandoning your core positions. Also, remember that risk still exists. There's no risk-free strategy in options trading. Every choice involves trade-offs, and even protective strategies carry some level of cost or uncertainty. The goal isn't to avoid all risk, it's to manage it in a way that makes sense for your goals, your portfolio, and your comfort level. Managing risk is a key part of successful options trading. By controlling position size, diversifying your trades, and using options strategically, whether to hedge or generate income, you can focus on potential rewards while keeping your risk in check. If you'd like to build your skills further, check out our course on how to trade options. You'll find the link in the description box below. And if you're ready to take the next step, watch our video on the option Greeks to see how they can help you shape more confident, well-informed trades.